Hello, everybody, and welcome to the Cyclical Investors Club. My name is Corey Kramer. Today, we're going to be analyzing Ulta Beauty. I last did a video on these guys when I first relaunched the channel back in early October. They've had a couple earnings reports since then, and the stock price is down quite a bit off its high. I'll look at that in a second. If you have a request you'd like me to look at, if it's a stock that's in the S&P 500, I post those on YouTube for free, and the rest I post in Patreon, which is $5 a month. And if you join there, if you ever decide to join the full Cyclical Investors Club service over on Seeking Alpha, where I have all the spreadsheets and a chat room where you can chat with me, direct message me and everything, you can get a big discount over there if you're a Patreon member. There's also a free Patreon tier now that I'm going to be adding some more content to this year. There's a chat room there too. So definitely connect with me through those other platforms as well as YouTube. And with that, let's get into Ulta Beauty. As always, this is not individual investing advice. This is just how I analyze stocks. I'll also be using fast graphs for quite a bit of this analysis. I have a 25% off affiliate link down in the description if you're interested in trying out fast graphs. That's a good way to support the channel as well. Okay, let's see here. Ulta Beauty. So I'll start off by saying that I am long Ulta Beauty. We bought this one in the Cyclical Investors Club during the 2020 decline, and basically I bought right about here. My thought process at that time was that eventually there would be, it might take a couple years, but there would be a COVID recovery and things would eventually reopen again. And so I basically used kind of the trend that was going into COVID. And I said, hey, if they recover like on the track that they were on before the pandemic, then this should be a pretty good price. Even though if you look, it was like a 31 PE at the time. I assumed that the earnings decline there would be temporary and that it would come back. So that's how I valued it at the time. That's done pretty well. This is a rough approximation, up about 90%. At one time, it was up over 100% just a couple months ago. Yeah, so it was doing really well there for a while. I haven't been following it too closely, but the quick take is this. We had experienced a big COVID recovery boom. Some of that was a return to normal. And then for some companies, and Ulta is one of those, it really stayed pretty strong after that. So you had 2021, which was a total recovery plus year. And then you still had 30% growth in 2022. And then last year, it was more like 8% growth, which really isn't that too much more than inflation. But what we didn't see is a decline in earnings, which certainly could have happened after the big run-up that we've had, the ending of stimulus money, the repaying of student loans. There's a lot of negative things that have happened, higher interest rates in the past year. So I would have expected there to be some sort of kind of retracement. We definitely saw it in other stocks like Facebook, Google, different types of companies, but they did benefit a lot from, well, let's just take a look at Meta real quick, just to show you like the pattern that I'm talking about. So you see last year or the year before in 2022, they actually had earnings decline, and then they have recovered since then. If you look at Alphabet, you see a similar thing. They had this big bump and then this return to normal. So Ulta had something similar, but they never really had that giant pullback. They could still. And I think that it could be a buying opportunity if that happens for investors that aren't in the stock yet. But what I would say is, I wouldn't assume this 25. I think the growth rate from, if we go from here to when they went public in the Great Recession to pre-COVID, the earnings growth rate was 30%, right? And even if you close this to kind of the more recent years, it was 25%. I think those type of growth years are behind the company now. And so going forward, I'm actually being really conservative, maybe too conservative, but given there's a chance that we could have, a recession, a slowdown, especially among like retail consumers, I think we could get kind of an earnings decline at some point in the next year or two. And so that could be kind of a slower growth period. We actually already see it. So they only grew earnings 8% last year. They're on track to grow them 2% this year. So the question investors need to ask themselves is, what growth rate do we think these guys can grow from here going forward to use as just a reasonable estimate? So I think it's probably too optimistic to use the past earnings growth, which is usually what I do. But these guys are building out all their stores, and now you can see Ultas pretty much everywhere in the U.S. And so that super fast growth is probably mostly behind them. So what I assume going forward is a 7% earnings growth rate, which actually is probably, let me see what analysts expect. Right now they're looking at, this year's expected to be slow, but then looking out, they're more like 10%. So, I mean, it's a ballpark estimate. You never know. But I don't see, I think if they do have an earnings decline like they had during COVID, maybe not that deep. But if they do start to struggle for a year or two, it's probably temporary. And fundamentally, they'll probably be able to pick up growth to at least a moderately, 7% when we have 4% inflation is not particularly, it's not a high bar that I'm setting here. So let's look at the metrics if we use the 7%. That's what the assumption that I'm going to use here. If we do that, even if we take into account some of the debt, I'm getting, just basic PE is about 15, which is pretty reasonable. You think 15 to 7% growth. If I include the debt calculation, which for these, I take the difference in the market cap and the total enterprise value. I look at how much percentage this is bigger or sometimes smaller if they have excess cash. And this is about 7% higher. So I just add 7% to the stock price when I'm doing the valuation. And so that's where this stock price. So I'm treating it as though it's trading at $423 a share. And when I do that, I get an earnings yield of 6.29%. The earnings yield is the inverse of the PE ratio. So earnings over price, and that will give you a percentage. So the way I think about this is if I bought the business for $100, I would earn $6.29 on that $100. So 6.29% earnings yield. And then that would grow, that $6.29 would grow at 7% each year. And what I want to know is how much money I could collect over the course of 10 years. I pull the first year forward, so I assume I'll collect $6.73 on my $100 the first year. I grow that at 7% each year, the $6, not the 106. And at the end, I get about $93 in profit on my $100. So if you put that in a CAGR calculator, you start with 100, you end with 193 or so after 10 years, and then you should get, so when we do that here, we get a 6.79% earning 10-year CAGR expectation. So you would expect to earn about 6.79% per year compounded over 10 years if you buy Ulta today. That's actually a pretty good valuation compared to this market in terms of relative value. I think Ulta is getting close to being a buy now for me, especially relative. I mean, I already own it, but and if I do a recession calculation using the 2020, I use 2020 recession data. I'm not going to go through the details of that here because it's so close to the normal buy price, but it's looking at, like 18 to 20% lower from here down to like 325 to 317. At 317, that's when this CAGR expectation would cross 8%. That's usually my buying threshold for just a basic calculation. So yeah, in this case, the recession PE is actually, the recession buy price is actually higher than the normal one. That's probably because of just the valuation compared to this decline here. It's just cheaper basically than it has been trading in the past. So now this isn't Great Recession data. This is kind of, not a full recession really. So it's a little goofy, but I definitely think it could go lower if we had a recession. It's not really trying to pick the bottom of a recession, but I think that this is a very fair price to buy it. Like really, 325 and below, it's pretty decent to start building a position, I think. That only assumes 7% earnings growth over the next decade. If we have inflation especially, it could be a lot more than that. So it definitely is more attractive, I think, than the market's giving it credit for right now. Not quite a margin of safety that I would like to have. But once you get down to 325 to 317, that looks like a buy to me. And even if earnings disappoint, I mean, the scenario where that happens is they miss earnings this year or next year, the stock goes down even farther. So the outlook in the near term will probably look bad. Like it'll probably not look good, but that's going to provide the opportunity for the longer term investors, assuming that the business, makes adjustments and still does pretty decent over the longer term. So that's my thoughts on Ulta. I went ahead and bumped this one up in priority just because it actually is kind of close to a buy price. Usually people give me a hard time for my super low buy prices, but we're almost there on this one. How much is the stock down? About 30%. Yeah, I haven't. Believe it or not, I have a lot of stocks, so I haven't really. And this one's just kind of locked in for the long term. So I noticed that it had fallen a little bit, but I didn't see how far it was down earlier. It went down. Yeah, so it's possible there could be kind of a technical bottom that gets put in, but I think it's really going to depend on earnings. And if you see earnings growth slow for this year and next year, you could definitely see the stock price go a little bit lower. All right, if you found this useful, hit the subscribe button, hit the like button. If you have a request, put it down in the comments. I'll get it on the whiteboard behind me, and eventually I will make a video for you. Later.